Hello, everyone, and welcome to a new episode of Finance Today, the show where we analyze the financial health of the world's most influential company. Today, we are focusing on a brand that needs not introduction, Nike, a global leadership in the sports and fashion industry that continues to attract investors, analysts, and consumers. Let's take a look at how Nike has performed over the past 3 years. A quick summary of Nike financial performance. Between 2021 and 2023, Nike demonstrated a financial performance with both highlights and concern. First one, revenue grown. Nike has steadily increased its revenue with 5% growth from 2021 to 9.7% from 2022 to 2023. This reflects a strong market demand and effective sales strategies. The brand remains a global reference. Decline in net profit. Despite the rise in sales, net profit dropped 16.2% into 2023 compared to previous year. This highlights declining profitability mainly due to rising operation costs. Vertical analysis. Profit margins in relation to revenue show gross margin slightly decreased from 45.9% in 2022 to 43.5% in 2023. Operating margin dropped more sharply from 12.5% to 9.9%. Net margin also declined to 9.9%, indicated lower profit per dollar of sales. Horizontal and trend analysis. A year-by-year look shows a clear pattern. Sales are increasing, but profitability is decreasing, especially in 2023. This raised concern about cost efficiency and spending control. Inventory and cash. Inventories rose significantly, which could signal preparation for higher demand or overstock due to slower sales. Available cash dropped from 13.5 billion in 2021 to 10.68 billion in 2023, which could become a red flag if not managed properly. Balance sheet highlights. On positive note, total liabilities decreased from 25 billion to 23.5 billion, improving financial health. Equity remains strong, slightly below 2022 levels, and total assets are stable. And to further analyze these results and answer some key questions, I'm joined by a special guest today, Rodrigo Taboada, finance analyst at Nike. Let's start with profitability, Rodrigo. What do the numbers tell us about Nike performance in this area?
Of course, Marcos, if we analyze profitability through our return of equity, we see that in 2021 it reached a remarkable 44.86%, meaning that for every dollar contributed by shareholders, Nike generated almost 45 cents of net profit.
However, in 2022 and 2023, this ratio dropped to 39.59% and 36.21% respectively. The main reasons is the decline in the net income, especially in 2023, which fell over 16% compared to the prior year. While still high, the downward trend shows that Nike is under margin pressure, primarily due to rising operation costs.
Let's talk about liquidity. Is Nike in a strong position to meet its short-term obligations?
Good question. Regarding liquidity, we have calculated a ROT's current ratio. Combining cash and inventories to total debt, this has hovered around 0.82 to 0.86 over the 3 years, which is not ideal.
The biggest concern is the drop in available cash from 13.5 billion in 2021 to 10.68 billion in 2023. Also, Nike still has significant liquid assets. This decline suggests the company in using its cash elsewhere, possibly in investments or debt repayments, and should closely monitor cash flows to avoid liquidity strain.
What about operational efficiency? Is Nike managing its resources well?
Here's an interesting development. If we look at inventory turnover, it was 3.69 times in 2021, dropped to 2.99 times in 2022, and then recovered to 3.42 times in 2023.
This tells us two things. First, the drop in 2022 could reflect overstocking or slower sales, a risk due to potential accumulation and unsold goods. Second, the improvement in 2023 suggests better efficiency in inventory management and a positive sign. Overall, Nike shows relatively agile turnover, which points to an active and responsive supply chain.
And finally, let's discuss Nike debt situation. Is the company financially well structured?
Yes, Marcos, in terms of financial structure, Nike has improved its debt profile. The debt to equity ratio went from 1.96 in 2021 to 1.68 in 2023, with a particularly notable improvement between 2021 and 2022.
This means Nike is less reliant on external debt, lowering its financial risk. Still, a ratio above 1 means that the company is more debt financed than equity financed, common in large corporations, but it must be carefully monitored to prevent imbalances.
Thank you very much for your time, Rodrigo. After reviewing Nike's financial performance over the past 3 years, we have drawn several conclusions. First one, a strong revenue growth amid margin pressure. Sales are increasing, but this has not translated into higher profits. Nike must address decline in margins. Second one, profitability under pressure. A 16% drop in net income 2023 raises concern about cost structure and operational efficiency. Third one, signs of financial prudence. Liabilities has decreased, indicating a move toward a healthier balance sheet and reduced financial risk. Last one, liquidity needs monitoring. The drop in cash reserves may limit Nike short-term flexibility and should be monitored closely. Here are some recommendations on the key points we think Nike should address going forward. The first one, strengthen cost controls. Implement tighter oversight on operating expenses, particularly in marketing and administration, without compromising brand strength. Second one, reinforce pricing on product strategy. Review pricing models and focus on high margin products. Invest in innovation and product differentiation to justify premium pricings. Enhance liquidity management. Ensure that capital expenditures and shareholders' return don't undermine liquidity. Focus on short-term debt and working capital optimization. Last one, optimize inventory strategy. Use real-time data and demand forecasting to align inventory levels with sales. This reduces store cost and minimize the risk of overstocking. That concludes this week's analysis on Finance Today. Thank you for joining us. We will see you next time with more companies, more numbers, and smart decisions. See you soon.